Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This particular video is going to look at General Electric, and it was a request from a regular viewer of our YouTube channel. And what they were really asking was, can you use FastGraphs to help you avoid all of the issues that happened to General Electric? Now, I want you to look closely here at what's going on with this company. First of all, I want you to notice the time frame here from 1999 to coming to the end of 2007, just before the Great Recession. I want you to notice, we're going to take the price off the graph here and the normal PE. General Electric's earnings growth was very strong here. If I use my scroll bar, I can go back in time here and see that General Electric was growing at about 9.4, 9.5% during that time frame, and it was also growing very, very consistently. Now, it had done that for several years prior to that, and this was under the Jack Welch area, which Jack was, almost a god in the, financial world because what he did. But what he really did was generate this orange line, and the market was valuing General Electric at these astronomical valuations up here. PE ratios 46, 47 using adjusted operating earnings. And then, of course, the 2001 recession hit, and like most companies, General Electric's stock price fell rather precipitously, but their business actually did well. Now, keep in mind, they had morphed from an appliance manufacturer, simplistically stated, to a financial conglomerate at this time. That was one of the big moves that Jack did. And this was during the cheap money, and this was all a prelude, if you will, to the Great Recession, which of course occurred in 2008, which was really related to the collapse of financials. And here we started to see the first couple of what I'll call breaks or chinks in the armor. We started to see earnings beginning to drop. And I want you to notice you would have had several quarters here. If you look at it from a one-year point of view, General Electric's earnings dropped by 12% in 2008, but clearly you were getting bad quarters. Their dividend held up. This would have been a precursor that something was wrong, and of course the stock price fell precipitously. Now that might not have helped you much because the stock prices of almost all stocks were falling during that time because it was the Great Recession. But General Electric was trading at a very high valuation. We're using a PE ratio here of 9.1, and the blue line is a PE ratio of 20 during this time frame utilizing the Graham-Dodd formula. But you can see that earnings fell dramatically. Then in 2009 they actually cut their dividend. They cut it virtually in half, and you can see that here. The dividend went from $1.24 to 61 cents. That was a 50.8% cut in the dividend. Now that's another warning that there were problems. Now, after that, and coming out of the recession, if you go up through 2014 here, General Electric started growing again, and I can actually bring this time frame over here, and you can see that during this time frame we're growing at 9% again. I'm now using a normal PE and a fair value PE of 15 based on this 9% growth, and you can see the General Electric stock price was tracking a 15-ish PE very almost perfectly from end of 2009 through 2014. But then along came 2015, and once again, we saw some weakness in earnings. We actually had a 21% drop in earnings. Now, at this point, General Electric stock price held up. You'll notice it continued to grow. And then if I move this over 1 year, we had an increase in earnings of 14% in 2016, and that kept the price up. But then as we started going forward again into the future years, we started to see another chink in the armor. Now, somewhere along here, back in 2016-17, you would have been able to notice that the earnings were starting to weaken. There was, obviously, this is where the research and due diligence comes in. And then, of course, they ended up reducing the dividend again. In 2018, we reduced the dividend again. So let me go ahead and bring this all the way out. I'm going to bring this all the way back and look at the whole picture again. So then they virtually eliminated the dividend in 2018 and 19, as you can see. It went down now to 4 cents a share in 2019, and that's a huge cut or virtually an elimination of the dividend. And of course, the stock price is fallen. So what you have here is you have several periods where you would have had certain amount of time, if you will. Doesn't mean that you wouldn't have suffered losses because you'd had, a lot of times you get surprises with these earnings reports and these dividend cuts. But there are other things you could have also done. You could have looked at, for example, free cash flow, which is, if you're worried about dividend coverage, you started to see some of these chinks in General Electric's armor. Now that would have helped, but it wouldn't have really helped that much. We saw a big drop in free cash flow during the recession, and of course that led to the cutting of the dividend, for the 2008-2009 period. But then we saw free cash flow covering the dividend, but then coming into 2015, 2014 into 2016 here, we saw this complete, free cash flow go completely negative, and it was negative for almost 2 years here. So if you were looking at free cash flow here, even though the company was still paying the dividend, and then if I go back to earnings here for a moment, if I go back to adjusted operating earnings, if you were just looking at what most people see in terms of operating earnings, you would have seen what I'll call weakening results, but you would have still seen, positive earnings growth. But it was really those cash flows, I think, that would have given you the big clue that the company's dividend was, possibly in jeopardy. Now, here's finally the $64,000 question. If I go back to adjusted operating earnings, and then I'm going to move into forecasting here. The question is, if you look at General Electric today, is it a good investment? Now, the reality of it is there are forecasts for some pretty strong growth going forward. There's a bunch of analysts that are making that forecast. So technically, if these analysts were right, now there's virtually no dividend, and there's not any expectation of any real dividend payments. This company is expected to go into a growth mode, but the long-term growth rate's only expected to be about 7 or 8%. So I personally consider this stock, off my radar screen. I'm not interested in looking at General Electric anymore. Even coming out of the recession where they went 4 or 5 years, we had management changes again. I just don't trust this company anymore, and that's, my problem. But I personally wouldn't invest in it. But could you have been warned? I think the answer is yes. You had, significant times where, keep in mind, it took 4 quarters for this drop to happen and another 4 quarters for this drop to happen. So if you're paying attention to fundamentals, and then you're using sites like, you could be using a site like Seeking Alpha, for example, and you could be looking at, all the news that's going on to help you determine. You could read other people's articles right from Fast Graphs. Of course, you could go into the company's corporate website, and you could go into investors and look for any information, press releases, presentations that are, going on with the company. You could also go to places like Bloomberg, or, I happen to be a subscriber of the Wall Street Journal. If you own a stock and you've got some issues, this is where you can find some information, but be careful of separating the noise from the news, and don't react to everyday stock price movements, because the stock price line is always going to wiggle. What you really want to do is focus on the orange line, and of course the General Electric, the white line. Anyway, this is, how Fast Graphs could have helped you. You should have never even been thinking about General Electric back in 2000, 2001, and 2, because the valuation was crazy. That was the question. It was still very highly valued in 2002 and 3. It had good earnings. Earnings appeared to be fine, and cash flows appeared to be fine. But as we all know, that turned out to be a delusion, not an illusion, but a delusion, because that was the toxic, liberal lending policies that General Electric was participating in as they built up their financial side of their business. And of course, that's now gone, and the company's trying to re-find itself, but I don't think it still has. Anyway, here's my General Electric overview and the lessons on valuation that it teaches. Again, it's not a company I would personally like, but there are some lessons to be learned here. Thanks for watching. If you like these videos, please don't forget to hit our subscribe button. Thanks. That's Chuck Harnville saying thanks again.